And now our top line story. Two more big Canadian banks have reported financial results this morning, Bank of Montreal and National Bank of Canada. One of the big themes of this bank earnings season is becoming very clear. Every bank that has reported so far has increased its provisions for credit losses, money that is set aside to cover loans that might not be fully repaid. That's important to investors because every dollar in a provision is a dollar that comes off bottom line profit. At Bank of Montreal, analysts are already pointing to the higher than expected boost to loan loss provisions as a reason for this big earnings miss. BMO reporting $2.59 in adjusted earnings per share, $2.77 was expected. Meanwhile, National Bank of Canada delivered a solid earnings beat, while also raising its provisions for credit losses, however. Both banks, on a brighter note, have announced increases to their quarterly dividends. For insight, let's go to our featured guest of the morning. He's Paul Harris, portfolio manager and partner at Harris Douglas Asset Management. Paul, thanks a lot for being here.
My pleasure.
Let's take a bit more of a detailed look at these numbers. There's not much doubt that provisions for credit losses are the common thread in these two sets of results and the results we've seen from other banks so far this reporting quarter. Here's the picture at BMO. Adjusted profit in the aggregate declines by 7% to $2.03 billion in the fiscal second quarter. This is the quarter, of course, that ended on the final day of April. The provisions for credit loss number rises by 12% from the prior quarter, not from the year ago period, but from the prior quarter to $705 million. And again, all of that is money lost to profit. And the dividend is raised by 3% to $1.55 per share. Here's a similar look at National's results. Adjusted profit rises by 9% to just over $900 million. Provisions for credit losses rise by 15% from the prior quarter to $138 million, and the dividends raised by 4% to $1.10. What are you seeing here, Paul Harris?
Well, I mean, I think this is, one of the things you have to remember with credit losses is the provisions. It's important that they're able to do this because it's, they're looking at, not all of those provisions necessarily will be used. So I think banks have become much better at understanding their credit loss book, their credit book rather, and understanding, what they have to put aside for all this stuff. So as you said, it comes off the bottom line, but it also adds to the bottom line if they ever never use it
Correct.
In a few years from now or something like that. So,
Correct.
I think they're much, in previous, like maybe 20 years ago, they didn't understand the credit book as well, and they were really much more more localized in many ways. Like TD Bank was much more of a Toronto bank or Ontario bank as opposed to much more of a bank across Canada and North America. So I think that's helped. It's important to understand that they understand their credit book a lot better these days. They have more analysis about it, and they're setting aside these things in just in case something happens, right? So that's a healthy thing for them to do. They've still got lots of capital, all these banks. If you look at their capital ratios, they're well above what's required, and so I think that's very important. They're increasing their dividend, which is also very important. I think one of the issues that banks have had is that, and it's very hard for them, is that they really need to probably cut back on their expenses a lot more. And that's a very hard thing for a bank to do. The parent of this network cut a bunch of people and they brought in front of the Commons, right? So I think banks are very hard pressed to sort of say, listen, we need to lay off 10 or 15% of our staff. And I think that's what banks really need to do is cut back on their cost structure. But they won't be able to do that as quickly as, just laying like an American bank could do. But saying all that, I think that the numbers are, there's a lot of positive things. One, they've, like I said, increasing their dividends. They've got lots of capital, which will help them through any difficult period. Certainly, the Canadian economy appears to be substantially slower than the U.S. economy, and I think there's a real feeling that the Bank of Canada is going to probably reduce rates in June. And you have to remember also, the Bank of Canada was well ahead of the Fed in raising rates, like Sweden was, like a lot of these countries that actually drop rates. So Bank of Canada is probably in an area where they probably can afford to bring down rates. I think the big issue with that is, what happens to the Canadian dollar, right? And how does that have an inflationary impact? But I do think that, banks have had a couple of really tough years. And I think that they're great businesses to own in this country over the long term. They tend to have, very good ROEs. They tend to kind of grow their dividend regularly. So I think they're great assets to buy. It's just that they're going to a difficult period, and I would say this is the time to look at them when the provisions are higher, when all these things are happening to them. That's the time you want to own a bank, not when things are going blockbuster for them. Right?
What's it telling us about the Canadian consumer that provisions are rising at all these banks? One number we haven't talked about yet is that at BMO, the provision for credit losses on impaired loans, that's a different number. It's on the portion of the loan book where there are already problems. I mean, an impaired loan is a loan that's behind, I believe, by at least 90 days or so.
Yeah.
So that provision has risen significantly from a year ago is the number I'm seeing. And I don't have a comparable for national, but that portion of the loan book is worsening as well. What's that telling us about the Canadian consumer and the Canadian economy?
Well, I think it's, banks are a representative of the economy of the country, right? So I think they're and that's why they're really important when bad things can happen, they have to be saved. But I think it's telling you that the Canadian economy is in a much more difficult situation than other parts of other countries around the world, and that the Bank of Canada will probably need to kind of lower rates over here, because I think that it is slowing down at a faster pace. And I think the one part I think this is the big, difficult part about what's happening with the economy is that you haven't seen unemployment kind of collapse, right? Which you'd probably see in a recession normally. And I think that's what's kind of made everybody hesitate about doing something. But I do think it tells you that corporations and individuals are having a harder time, especially on the mortgage side, because rates are so high, and most people went to a variable rate mortgage, right? And so their rates have gone up a lot. So I think that those are having a real impact on the Canadian economy, and I think that we need to. I think there's a strong feeling that the Bank of Canada is going to do something in the next couple of weeks. I guess next week, I think, right?
June the 5th. Let's just circle back to a brief comment you made. You said this is the time you should be looking at these banks. So you believe it sounds like that long-term investors would be wise to be adding to their positions in Canadian banks.
Yeah,
right now.
I mean, I think over the long term, these things have been great stocks to own, and I think that you want to buy them when there's adversity. They're facing a lot of stuff, as opposed to saying, well, things are wonderful and it's 2007, right? Or these are the times to look at these companies. They're trading at much lower multiples. They're trading at very high dividend yields. So it kind of pays you to hold them. And over a period of time, the Canadian economy will get better, and we will start to grow again, and you will have a chance these stocks will do very well. And they're substantially more diversified than they were 20 or 30 years ago, right? They are in capital markets, they're in asset management, they've got strong retail franchises, they're in credit cards, they're in all kinds of different things that they probably, they're much more diversified, and they get much more, less interest income and more income from other sources, right? So I think that's what's helping. You have to remember they're much more diversified businesses than they were years ago, and so I think that's very important. And as one part does well, some parts will do better. I think capital markets did very well for National Bank, right? So I think and they are very high ROE businesses, those kind of businesses, when they're kind of clicking. So I think we have a chance to see those things all come back and do well.